Okay, so we're going to talk about. I jumped ahead here. We're going to talk about dividends and how it's related to reporting and the issues that come into play as a result of that. And so let's go ahead and get into this section, okay? And few companies pay dividends in amounts equal to their legally available retained earnings. Why? And the reason why, in other words, what they're saying is that they don't necessarily give out all of their retained earnings. So if I have a $500,000 in retained earnings, I don't give out a $500,000 in paid dividends. And there's a reason why. Well, these are the reasons why. Because sometimes we have agreements with creditors. We're obligated to pay them back. We have state and corporation requirements. We talked about par value, and there may be some conditions along that line. We may use retained earnings for future growth or expansion. We might have to smooth out dividend payments. Maybe we decide that we're going to do 2% of share price over 6 years or something like that. And then the other thing is, what happens if there's a loss? What happens when the company is not doing well? We have to pull from retained earnings to be able to rely on the times when things are really tough, so to get us through those things. Okay, so these are the reasons why we may not pay out dividends fully. This is typically what we would have on a dividend policy. It's a company should not pay a dividend unless both the present and future financial position warrant the distribution. The SEC encourages companies to disclose their dividend policy in their annual report, especially those that have earnings but fail to pay dividends or do not expect to pay dividends in the foreseeable future. So we have an obligation if we're a public company. The SEC encourages companies that consistently pay dividends to indicate whether they intend to continue this practice in the future. And so that comes into play with how investors foresee a company. If a company is stating, hey, we're going to consistently give 4% dividends, and it has a dividend yield, of 4%, then chances are, if they have been consistently doing that and they are speaking of doing that in the future, that is going to create a higher value in the stock price, and investors might be more attracted to that company than, say, a company who did not have that policy. Okay, so that's the reason why SEC is encouraging that. It's just to help really give a good fair market value of a share price of a company. There's types of dividends. We have cash dividends. We have property dividends, dividends in kind or like-kind exchange. I'm sorry, not like-kind exchange, like-kind dividends. We also have liquidating dividends. All dividends except for stock dividends reduce the total stockholders' equity in the corporation. Stock dividends do not. We usually call that a stock split. It reduces the share price, but because we have more shares issued, the value does not reduce the equity at all. Okay, and we'll go into detail on that. If we have a cash dividend, board of directors vote on the declaration of the cash dividend. A declared cash dividend, this is key. We have is declared a liability. Companies do not declare or pay cash dividends on treasury stock. All right, so this is common shares, or this would be preferred shares. Treasury stock, remember, we're buying back. That's our own stock that we've bought back, or the company's bought back. And so we don't do any sort of dividend on this type of stock. There are 3 dates to note. One is the date of declaration, one is the date of record, and the other one is the date of payment. Whenever it comes to the date of declaration, that's when we record it as a liability. When it's a date of record, we don't do anything. It's just more of a printing standpoint from someone just not even keeping account. This would not be talking about keeping accounting books. This would just be having a record of date of when it was declared. Then there's a date of payment. That is when we reduce the liability and also dispersed in cash. So this is an example. David Freight Corp. On June 10th declared a cash dividend of 50 cents a share on 1.8 million shares payable July 16th to all stockholders of record on June 24th. So they declared it on June 10th. So if it's declared on June 10th, that's when the liability is. It's paid on July 16th, okay? And that's when we reduce the liability and disperse cash. So date of declaration is June 10th. Retained earnings gets debited, and dividends payable gets credited. So we didn't pay anything yet, but we record the liability. Then a date of record, there's no entry. And then the date of payment, which is July 16th, is when we reduce our liability and just simply pay cash, okay? So that's a cash dividend. A property dividend is when we have dividends payable in assets other than cash. It could be machinery, equipment, it could be land, it could be, who knows what it could be, anything of property value, okay? We restate at fair value the property it will distribute, recognizing any gain or loss. So the key is if we have a machinery, let's say, that we want to get rid of, and we're going to issue that in a dividend to someone, that person would receive that value of that receive that property at fair market value. And then from a company standpoint, we record the disbursement of that property at fair market value, recognizing the gain or loss, because we may have depreciated some of that equipment. So we have to basically reverse the entry of selling the asset. The difference between the depreciation and the the value of that property at original recording is what we call basis. And so that difference, that basis versus fair market value, is going to be our gain or loss. So let's look at this example here. Hopkins transferred to stockholders some of its equity investments, costing $1.25 million, by declaring a property dividend on December 28, 2016, to be distributed on January 30th to stockholders of record on January 15, 2017. At the date of declaration, the securities have a market value of $2 million. So we know it costs $1.25, but there's a $2 million valuation. So we make the following entries. So we have a date of declaration. We reduce the investments by $750,000. That reduction in equity investments is the difference between $2 million and $1.25 million, okay? Then we have an unrealized holding gain or loss of $750,000. So this is considered a separate transaction, okay? And the reason why is because we have to recognize this gain. All right, then the next step is going to be to take the retained earnings, and notice we took the retained earnings at the fair market value, which is the $2 million. And so we issue a payable of that fair market value, which is $2 million, okay? And so, as we said before, the difference of the two less than 1.25 is $750,000. At date of distribution, then, we're going to just reverse this entry of the $2 million, and notice we have the equity investments, which is the original, which is the fair market value of the value itself that we recorded in this payable here. Actually, it was recorded earlier. And so we reverse the payable. We credit our equity investments of that $2 million. Okay. All right. Then we have this potential of a liquidating dividend, okay? It's any dividend not based on earnings reduces corporate paid-in capital. The portion of these dividends in excess of accumulated income represents a return of part of the stockholder's investment. And so let's look at that. Henry Mills issued a dividend to its common stockholders of $1.2 million. The cash dividend announcement noted stockholders should consider $900,000 as income and the remainder a return of capital. And the reason why we would have a liquidating dividend is if the company were to close down. So my original investment might be $300,000 here, because that's originally what I put in, but I'm getting $1.2 million back, so that difference is going to be the return of capital. Okay, so declaration, retained earnings, we only have $900,000, paid in capital excess par common $300,000, and dividends payable $1.2 million. Date of payment $1.2 million, and we reverse this out at $1.2 million. Okay, let's say I'm a 10% owner of the company. How does this translate to income? So we have $900,000 paid in capital, just like how we normally do, and we have $1.2 million, and apparently I didn't write that in there. But if I'm a 10% owner, the tax consequence of this would be that I have a $1.2 million, so that's $120,000 common stockholder dividend, and $900,000 as income, and the remainder return of capital. So the way I would look at that is $90,000 would be considered a potential capital gain, and the $30,000 would be considered a return of capital. Okay, so that's from a tax consequence. Okay, so we have one more thing, stock dividends and splits. Issuance by a company of its own stockholders on a prorata basis without receiving any consideration. Used when management wishes to capitalize part of earnings. If stock dividend is less than 20 to 25% of the common shares outstanding, company transfers fair market value from retained earnings. Okay, so here's an example. Cobley Corporation has outstanding 1,000 shares of $100 par value common stock and retained earnings of 50. If Cobley declares a 10% stock dividend, it issues 100 additional shares of to its current stockholders. If the fair value of the stock at the time of the stock dividend is $130 per share, then this is how we record the entry. So we have this $13,000 retained earnings, right? And we have a common stock dividend distribution of $10,000. The difference is this paid in capital in excess of par common. Notice because it's 10%, 13,000 from 130,000, 10,000 from 100,000, and 3,000 would be the difference. When we distribute it, we have a 10,000 share distribution, and we have a common stock of 10,000. Okay. Stock splits, we reduce the market value of shares, but there's no entry record recorded for a stock split. We just decrease par value, and it increases our number of shares. Notice that when we do a 2-for-1 split, we have 1,000 shares at 100, okay? But now we have 2,000 shares, but it becomes 50. So the value remains the same on a stock split, okay?